Understanding NV, the Naamloze Vennootschap. What is an NV? The term NV stands for Naamloze Vennootschap, which translates to nameless venture in Dutch. An NV is a type of public limited liability company that allows for the sale of shares to the public, making it an attractive option for businesses seeking to raise capital. Similar to corporations in the United States, Inc., or public limited companies in the United Kingdom, PLC, the NV designation appears after the company's name. This structure is predominantly found in the Netherlands and other Dutch-influenced regions including Belgium, Aruba, Suriname, and parts of the Caribbean. Key takeaways. NV is a public limited liability company structure primarily found in the Netherlands and other territories influenced by Dutch law. Companies are required to have a minimum startup capital of €45,000 to establish an NV. Directors of NV are not personally liable for the company's debts. Shareholders can remain anonymous, as their identities do not appear in public records. How an NV operates. Operating an NV involves navigating various regulatory frameworks that depend on the country of incorporation. Here's how it works primarily in the Netherlands. 1. Initial requirements. A minimum capital of €45,000 must be deposited to establish an NV. Notarial services are also required to draft the Articles of Association, a formal document outlining the company's purpose and the duties of its directors. 2. Registration. After the notarial deed is prepared, the NV must be registered with the Netherlands Chamber of Commerce and entered into the Dutch Commercial Register. 3. Shareholder structure. An NV typically issues shares to investors, granting them decision-making authority which includes the power to elect the board of directors. Unlike private companies, the shareholding of an NV is usually open to the public, allowing for trading on stock exchanges under specific regulations. 4. Taxation. NV entities are subject to corporate tax rates. Directors receive salaries and pay personal taxes on their earnings, while shareholders pay dividend taxes based on their shareholdings. 5. Liability considerations. The structure protects shareholders from personal liability, meaning they are only liable for the company's debts to the extent of their investment in shares. Special considerations for NV formation. Although businesses can start operating prior to formal registration as an NV, the directors will bear personal liability until the registration process is complete. This underscores the importance of effective corporate governance. For an NV to be listed on a stock exchange, several criteria must be met. The company must be at least 5 years old. It should possess equity of at least €5 million. Must show profitability in at least 3 out of the previous 5 years. If shareholders decide to dissolve the NV, they must settle all debts and distribute remaining assets before officially closing the company. NV structures in other countries. Beyond the Netherlands, the NV structure exists in varying forms across several countries. Belgium. In Belgium, the NV primarily raises capital and requires at least 2 shareholders. Aruba. Companies must obtain a business license and register with the trade registry at the Aruba Chamber. Residency is not required for shareholders. Indonesia. The equivalent structure is called Perseroan Terbatas, PT, which can be open or closed and requires specific licenses and registration certificates. NV versus BV. The NV is one of several types of corporate structures available in the Netherlands. Another common structure is the BV, or Besloten Vennootschap, which is a private limited company. Key differences between the two include: public versus private. N.V.S are public limited companies, whereas B.V.S are privately held. Minimum capital. An NV requires a minimum capital of €45,000, while a BV can be established with just 1 cent. Number of shareholders. B.V.S can function well with a single shareholder, while an NV typically needs multiple shareholders to facilitate public trading. Advantages and disadvantages of an NV. While establishing an NV can provide numerous benefits, it is essential to consider both advantages and drawbacks. Advantages. Tax benefits. N.V.S can benefit from corporate tax rates and deductions. Shareholder anonymity. The names of shareholders are not disclosed publicly. Limited liability. Directors are shielded from personal liability for company debts. Disadvantages. Higher startup capital. The requirement for €45,000 can be a barrier compared to a BV. Regulatory burden. Higher capital and share thresholds exist for public trading. Vulnerability to acquisition. Since shares are not registered, they can be more susceptible to acquisition. Real-life example, EXOR NV. One prominent example of an NV is EXOR NV, a holding company with a diverse portfolio, including major brands such as Fiat Chrysler Automobiles and Ferrari. Founded in 1927, EXOR showcases the strengths of the NV structure, operating successfully with significant global investments and a market capitalization around $18.2 billion as of early 2022. Conclusion. The NV, or Naamloze Vennootschap, represents a crucial option for businesses looking to raise capital while providing shareholders with limited liability and anonymity. Despite its advantages, obtaining the required startup capital and navigating the related regulations requires careful consideration. For entrepreneurs and investors in Dutch-influenced regions, understanding the nuances of the NV structure is vital for successful corporate operation and governance.